Dornbush download number 96 closing in on the ton. Andrew, Michael, good morning.
Good morning.
Good morning. Good morning. Michael, Reserve Bank, what happened yesterday?
Yeah, look, of course, first Tuesday of the month, Andrew, so interest rate decisions, keeping the interest rate steady at 1.75%, so no real surprise, but again, dovish tones certainly surrounding inflation, and that's been the commentary now for a good while, that exchange rates as well. We've seen, very, very low wage growth over the last 6 months, 12 months. All eyes will now be looking at inflation figures coming out in late July. And if they're on the low side, look, it's looking more and more likely that we're going to get an interest rate cut in August. Just had a quick look at the ASX website. They put on there a little probability chart based on sort of short-term money markets and that sort of thing. There's now a 55% chance of an interest rate cut in August, so back to 1.5% if that's the case. So we're sort of keeping on breaking these records, and as you know, Andrew, I mean there are the pessimists out there that are saying 1% interest rates are not out of the question. I know one of the very highly regarded guys that talk on the ABC, he's talking, we could have low interest rates for the next 5 years, anywhere between 0 to 1%. Yeah. So, not much fun if you've got money in term deposits and in bank accounts. Certainly pretty good if you've got a mortgage, no doubt. But I think there's only about 40% of the population have mortgages these days, something like that. So there's a lot more people probably hurting on lower bank interest rates rather than people gaining on better mortgage rates.
And all the doom and gloom merchants about the banks and they're in trouble and all that type of stuff. I mean, it's not inconceivable, but it's pretty hard to see how people are going to go bad when your home loan is 4%. Yeah. And in fact, the new ones are like 3.6 and 3.7% fixed for 3 years. Mm-hmm. So I'm not suggesting for a moment, and banks is another whole other conversation, but in a falling interest rate environment, their NIM, their net interest margin, is under pressure. But just from a context of people going bad on them, it's pretty unlikely for them to go bad. And, for those of us who've got credit cards, hopefully not too many, using them smartly, making sure you pay for your balance at the end of every month, like that interest rate hasn't changed. Yeah. Like they're still 19.99% interest rates. Mm-hmm. So the banks are making a mozza on that stuff. So in a falling interest rate environment, it's even better. So, and every time they drop rates, the phones here just go ballistic because you have clients who have got money in term deposit, self-funded retirees who need to drive that 4 or 5% per annum pension going, can't do this anymore. It raises some real challenges around risk return, doesn't it?
It does, yeah. It poses a lot of tricky questions for a lot of investors out there. Again, there are people still licking the wounds from the GFC. There are some people that would argue we're probably still in a GFC-like scenario with the volatility and things on markets. So it is. It's a tough gig, particularly if you're a bit more risk averse, because it will mean that it's more than likely you're going to have to take that jump out of the comfort zone and try something, a bit spicier, so to speak. So.
One other thing, just as you were talking, I was thinking, and we didn't cover off on it before. We have a little chat before. What are we going to talk about? I don't know. What do you think? Is the election?
Yeah. Yes.
And the Reserve Bank, of course, is apolitical, but, they have to be very mindful of what's actually going on, or as it would be not going on in Canberra at the moment. I mean, you've got, is it Coalition 71, Labor 70, 4 undecided and 5 independent. So basically no one can actually get, based on those figures, can get a majority. Yeah. So what happens from a government point of view? We've got a reference point back to 2010 where we had that minority Labor government with the Greens. Mm-hmm. Does Bill Shorten do a deal with Xenophon and the Greens? Does Malcolm do a deal with Bob Katter? Who knows? Yeah. And that's why I think we're seeing the last couple of days, the share market, it was a bit optimistic day one because Malcolm said, we'll have a majority government. But the last couple of days, people are going, no. don't think so. And that's what do you think?
Oh, look, absolutely, Andrew. I think, this is potentially one of the worst case scenarios politically. We could be back in. So, whenever there's uncertainty, markets hate uncertainty, as everyone knows. And until we get a result, which is looking like it could be another week or a couple of weeks away at least. As you say, whether it's a minority government, whether we go back to the polls and have another election.
Only 180 million if we take that option.
Yeah, so, we are flying really a bit blind at the moment. So.
And the other thing, just to sort of, and I'm sounding very pessimistic today, is, the Senate. Like, you've got Darren Hinch and you've got Pauline Hanson and, like they were worried about the last Senate. I'd actually be worried about this Senate. So it's just a circus.
It is.
We don't make political comment, but it's just a circus. Wake up to yourself, seriously. Okay, last thing is we're doing an IPO at the moment, an initial public offering for a company called US Select Private Opportunities 3. And in essence, it's a listed company that will be focusing on US private equity. The company who's floating it, they're called Walsh & Co. They've actually got two previous listed companies, USF and USG from memory, and each one of those have returned between 11 and 13% per annum return. So they've got a pretty good track record. Probably the big thing that if you're chasing income, and a lot of the conversation today has been around income, it does not suit you. It is not an income play. But for those clients who are looking for diversification, and I spent a bit of time last night, yes I am sick, looking at Harvard's endowment portfolio. So Harvard have $37 billion in their endowment portfolio, and looking at the performance from 1974 to now, they've returned on average about 12.2% per annum. So 74, if you think, was a pretty ordinary year. 77, it was down about 40%. 1987, like the whole kit and caboodle, up 12%. And modelling the same portfolio but only having shares and bonds in it, 60-40, would have driven a 9% return. So basically that extra 3% or 25% outperformance relative to that other portfolio is because they have other assets in there. They have unlisted property and they have a very heavy bias on private equity. So their minimum share allocation is only 6%. 6%, whereas the private equity, the minimum balance they have in there is 13%. So there is a lot to be said for having private equity in your portfolio, and I guess we've always not shied away from it, but we've just been incredibly mindful of the illiquid nature of it and that lack of income. So for a lot of people, lack of income knocks them out, and for those who are left, the lack of liquidity has knocked them out. But this product and the previous two have actually sort of now got the liquidity side of it covered off. So we're seeing pretty good demand for it. So if you are interested in getting some, have a chat to me or Michael or Dan when he's getting over his man flu, and we can take you through it. But certainly from a diversification point of view, this one looks interesting. Michael, anything else from you?
Yeah, no, that's about it, Andrew.
Till next week.
Thank you.